More and more traders are using something called Market Profile to help them find good opportunities in the markets. Our guest today is Mike Toma. He's going to talk to us about that. Mike, thanks for being here.
Hi, Tim.
Well, first of all, talk about what Market Profile is.
Really, when we hear about Market Profile, there's a lot of terminology that goes along with it. And to really keep it simple, it really just takes volume and price. So there's really no moving averages or any other type of stochastics or any type of indicators like that. What it's doing is taking, say, for example, for the day, it takes all the different prices that were traded during that day, and it takes 70% of all of them, which is traded in the range where 70% of the volume has gone off. It's as simple as that. If you look at it as sort of a bell curve or a pendulum on a clock, right? The price goes back and forth, just like a pendulum on a clock. It swings in different ranges. And at the end of the day, or end of any time period, wherever the volume is hit the most, that's really the area we call Market Profile.
All right, and how do I use that knowledge to make good trades?
Yeah, well, there's two different types of market. There's market status that I look at in Market Profile. You have sort of a balanced market and imbalanced market. And what that really means is, to really keep it simple, is if you ever notice, even sometimes during the lunchtime hours, you'll see price just chop away up and down with maybe a certain range, a very small range. What Market Profile is doing is it's in a balanced state. The market is accepting those prices. And those fluctuations are just certain buyers and sellers, maybe position hedge funds doing their thing. But for the most part, during that time, in a balanced state, and again, think of that pendulum going back and forth in a slight range, you could just trade those up and down. In Market Profile, we have a thing called the value areas, and that's what that range is. It's a value area high and a value area low, and we just trade those up and down in a range. It's real as simple as that.
So does it somehow smooth it out for us a little bit so we're not seeing the aberrations of the high price and low price a bit?
Yeah, that's what it does. And what it does also is allow you know where you're wrong right away. Because sometimes a balanced market becomes an imbalanced market. Again, think of that clock pendulum going too far the other way. But the one thing we know is the market always ends up in a balanced state. Just like the pendulum always comes back to that center line. Now what happens is when it's in a balanced state, it becomes balanced and then becomes imbalanced. All right, you're seeing a lot of market volatility. The market's maybe dropping 100, 200 points. I look at that area as you're swimming with the sharks. Okay, you can trade those areas, but be careful. But my preference from a Market Profile standpoint is when it's in a balanced state. Think of it as the little sandbox that mom always says you can play in. It's good. It's less risk, and it's easy to play them, and you know where you're wrong. Once you get out of those waters, though, be careful. The sharks are coming. Great rewards, but watch out. The risks are higher.
Don't you need that volatility, though? Don't you need that movement to really make money doing this?
Not really, Tim. One of the best months I've ever had in my career was last December. And you would think December, the holiday season, a lot of days off, choppy markets. But all the market does is accept balance and trade in an up and down range. Granted, maybe only three ES points, for example. But when you take three, take another three, take another three, take another three, maybe a quick stop out here and there, I'll take those days any day.
Mike, thanks for your time.
You're welcome, Tim.